Before I get to Chris, maybe a brief introduction of myself. So I'm Jeroen, a partner at Speedinvest. Have been with the fund for 6 years. And prior to that, actually built a SaaS-enabled marketplace myself. Very happy to be back in Paris. I mean, I'm from the Netherlands, so we're really used to walking through the red light. And any country where it's like super normal to walk through red light, I can really appreciate. So I think it's really nice to be here. And yeah, we're going to talk a little bit about actually Chris's journey as he moved from, I would say, a marketplace that was highly unmanaged on the supply side to ultimately a marketplace that is very managed on the supply side. And with that, I'll start with very briefly the background on you, Chris, and then we'll kick it off with some questions, and we'll try to keep it brief so we can get to the drinks quickly. So, I mean, Chris, you had a very long career as a marketplace operator. First at La Fourchette, sorry for butchering the French. It's a restaurant booking platform that is acquired by TripAdvisor. You then moved on to Miro, I think one of the companies in Paris that's quite well known, raised a massive financing round of 230 million, where you were also the CFO at that time, so that was quite an interesting journey. And more recently, you moved to our portfolio company, Byrd, well represented on the t-shirt, which is actually an e-commerce fulfillment. And we actually want to use this conversation to actually guide a little bit through your journey as a founder. So I suggest we start off with La Fourchette, or the fork, as it's called now.
Yeah, it's been rebranded to the fork. So
Nice.
you don't need to butcher fourchette
Okay.
anymore. You can just use the fork, and it's been rebranded across all of Europe and also in Australia and Brazil. It's the fork all over the place now.
Right. So, I mean, for people that might not know the platform, maybe you can give like a quick intro
Yeah,
on
sure. I
what
think
it does.
if you live in Paris, you probably know the platform. It's a very typical restaurant booking platform. So for the users, you go on the app, you find a restaurant, you book a table. For the restaurant, you sign up to the fork, and all of a sudden you receive this traffic. So you need to onboard, obviously. You need to put a bit of inventory, number of tables, etc., on the platform, and then people can book a table in your restaurant. And the business model has been the same for ages. It's €2 per restaurant goer, €2 per pax. So party of 6 people, that's €12 that the restaurant pays to the fork for the traffic.
Nice.
That's the
quick
yeah,
one.
typical marketplace. So like Nicolas was saying, liquefying to the supply and the demand, and basically providing more traffic to the restaurants.
Yeah. And this was essentially like a very unmanaged marketplace, right? So almost any restaurant, I guess, could list themselves. So how was the kind of the organization set up to manage that supply side?
Yeah, so it's a paying service for the restaurant, so obviously there's a bit of sales going in there. There was a bit of natural inbound, so restaurants coming to the fork and asking to sign up, but a lot of it was, a very hyperactive sales team that was going to the restaurants and trying to onboard them. But yes, indeed, the more restaurants we had on the platform, the better the service was for the user base, and that's, so there was no particular filtering of restaurants that the fork didn't want to have on the platform. So yes, any restaurant could come over as long as they provided their financials so that we could invoice them, provided the inventory of number of tables to be booked on the fork, at what time frames, etc. But yes, basically unmanaged at the beginning, but then the real value to the user base, to the other side of the marketplace, was the promotions and making that restaurant base attractive. So the incentive to the user base was, adding promotions, which were financed by the restaurant owners themselves. So when you see a promotion on the fork, like 50% off the entire bill, that means that the restaurant itself is actually earning 50% less money, and that's where you need not curation, but account management, so to have account managers actually pushing the restaurants to become more attractive to the user base. So there were campaigns of account managers making sure that the restaurant was using the fork in the right way, making sure that there were a steady flow of promotions, that the data was actually accurate of number of tables that were available, etc. So there always was, it wasn't the Wild West, there was always some level of account management and of curation. plus the ratings, but that was mainly uncurated. The ratings were actually are still actually purely user generated.
Right, and I guess that user-generated ratings will probably also guide a little bit where the restaurant ranks on the website, right?
Exactly.
So it's basically like plain vanilla marketplace, like everybody knows it, I guess. I think when you just started there, they did take bookings on the platform, but they didn't take payments on the platform, correct? And then I think they switched to also having like a payment solution.
Yeah, and that actually took a lot of time. Because, well, during my time at the Fork, which was between 2015 and 2018, basically for 3 years there was almost a feature freeze on the system because the Fork had been developed on old technology, and so for about 3 years we were, the tech team was running the day-to-day operations while trying to switch to new technology, and so for 3 years all of those features like payment in the restaurant, like all the social features, like suggesting a restaurant to your buddy or creating a community of restaurant goers who could swap ideas, etc., or split the bill while you're at the restaurant. All of that was completely frozen, and that actually was very critical because it made the restaurant base, it made the user base a bit bored because there was so much stuff that you couldn't do on the Fork, and so that made the service of the Fork less attractive to the paying customers, which were the restaurants. And so in the mature markets, you could really see the growth dampening. And at some point, it even dropped below 20%, which was unheard of because it was, back in 2016, 2017, you expected a web platform to be doing triple-digit growth, and so in the mature markets, those feature freezes and that lengthy time to come up with improvements, that made the platform really not unattractive, but a bit boring and a bit redundant for the users, and that made it really complicated for the user base, for the B2B parts, the people managing the restaurant base, to actually show the attractiveness and show the value that the Fork was providing to the restaurants, besides from charging them €2 per customers that was coming in.
But eventually you did roll out some sort of like a payment solution, right?
Yeah, so and that was rolled out once the tech solution was sorted, but that was after my time. And yes, those features came up, and it goes through your account management team, so your curation of the supply to onboard the restaurants onto the new features. Mm-hmm. So you can actually roll it out to the entire restaurant base in a snapshot, but you do need the account management and the curation to gradually educate the restaurant base about your services, your features, and how to actually use them properly.
Yeah. So it wasn't quite like just switching a button in the back office and everybody would have payments. You would basically have to do that account management one by one.
Yes. Yes, because once the payment flows goes through the Fork and then to the restaurant, that obviously creates the complexity that you can imagine in terms of signing up the restaurants to those services.
Yeah. I mean, I guess for most people in the room, like marketplace, listing website where payments are being done is pretty much the standard, right? So I think that kind of brings me to Miro. I mean, obviously the marketplace that connects photographers to businesses for professional photo shoots. I think most of their customers came from, I would say, the likes of Airbnb initially and Booking.com and like making professional photo shoots of these kind of rooms. When we pre-discussed this, you actually mentioned that this was a marketplace that sort of went from like being unmanaged to much more managed to at the end quite highly managed, right? So would love to talk a little bit about that journey if possible.
Sure. Yeah, originally the concept of Miro was for real estate. So any realtor or even any person that would put their apartment on sale, the first thing you need is quality professional photographs to be able to put the photographs on all the platforms and actually get some buyers to be interested in your apartment. And so it started off really as one-shot on-demand photography, which was fairly unmanaged because you had a base of photographer and you would ping them, and regardless of we were kind of looking at the quality of the pictures, but you would expect a professional photographer who signs up on Miro. We would, kind of select them, do a test shoot to make sure that he was actually a professional, and then they were on the platform just like any Uber driver. We would ping them, send them a gig, and they would have 20 minutes to accept it or not. But it was always one shot. So the consistency and the quality of the photographer base was not that critical. But then gradually we moved upscale towards the Airbnb, towards Booking.com, the food photography as well, Uber Eats, Deliveroo, all of those companies. All of a sudden we went from sending one-shot gigs to photographers to needing to shoot 500 restaurants in one city within 2 weeks. And so that's where you need, and with extremely consistent quality of photographs. And that's when all of a sudden you need a much more curated photographer base than originally. So that's where we started spending a lot more on supply acquisition. So, you know, if you need to acquire a photographer in Bangkok, because we were shooting for Uber Eats in Bangkok, so shooting 500 restaurants over there, you need a photographer base of about 25, 30 photographers, and so you need to select them to spend a lot of money on actually acquiring that photographer base so that you can operate in those countries at scale with a consistent level of quality. And the consistency was key because the magic sauce of Miro is the artificial intelligence to actually take the pictures from the photographers. The photographers just take the pictures and then dump them on the Miro platform. And then what Miro does is do the entire editing, selecting, verticalizing, etc., and packaging automatically so that you don't have 100 people clicking to do the photo editing. And that actually works. There was a lot of saying that that this was actually people in India clicking on the pictures, but the technology does work on real estate. It works on food photography, and now it's being developed also on e-commerce photography. So still pictures of cars, of things that are being sold on eBay or whatever. So yeah.
But just kind of getting back to the shift from unmanaged to more managed, right? Was that then mostly driven by the fact that Miro went kind of upmarket and serving bigger customers that had bigger needs, so to say?
Exactly. So it was that shift, and we needed consistency so that the software could actually process the pictures from those photographs. And what the last thing we wanted was super creative, artistic photographers who would do their own thing. We wanted really standard pictures so that we could actually process them at scale, at a high level. And in order to, as I was saying, we had to acquire a lot of photographers across the world, and in order to do that, we spent a huge amount of money on PR to make sure that we don't have that bad of a reputation across the photographer communities. We spent it on. We even opened the Miro Foundation where we had photographic contests. Basically, at some point, we were spending over 200,000 euros a month to provide added value services to that photographer base. We developed a SaaS software where they could manage their own gigs, their own basically their living with accounting, because we were expecting them not to be we never had exclusivity with the photographers. Vincent from Malt was mentioning that there's legal aspects that you need to take care about when you become the sole contractor of those people, of freelancers or any person in the gig economy. So we weren't going for exclusivity, yet we wanted to have as sticky a base as possible. And so that's why we developed all of those add-on services where they could do their own invoicing and manage their entire activity as a freelance photographer on the site. And then on top of that, we would give them all the gigs that we could provide them.
Did it also require much more like training? Like, hey, you're now going to work for Booking on this particular job, so they want the picture to be exactly like this, or?
So that's where it becomes tricky because you can't call it training, otherwise they become employees, and that's not where you want to go as a marketplace because you want to keep the flexibility and have freelancers. So we were providing courses. We were so we did provide very strict guidelines when it came to a specific photo shoot, but not training. So it was guidelines.
So guidelines, not training. You know,
exactly,
it's
something very different. But yeah, on the side, we were providing indeed courses, etc. Basically we had a checklist of what we wanted to provide the photographer. The first thing was a good level of living. So we actually changed the algorithm to make sure that we concentrated the photo shoots and the gigs on one or on a fewer specific photographers than the entire than randomly spreading out the gigs to the entire base. So we had about 70,000 photographers, and we were focusing on 5,000, 6,000, so that those guys could actually make a living, because that was the first start to actually have a sticky supply, and not somebody who was taking one gig and then never replying to your emails or to your calls.
Yeah, I mean, you're stealing some of my impromptu questions, but I think I can imagine if you're initially building this marketplace and it's like a purely unmanaged marketplace, you're just onboarding a bunch of supply, right? So the 70,000 people that you mentioned, but then you kind of become much more managed, and I would imagine the pool becomes much smaller. So you might need much less photographers to still service the same kind of revenue base.
Exactly.
I guess it also then kind of changed the whole acquisition strategy for photographers, right? Because initially it was almost like anyone who would like to make pictures would be good for us, but now we know we might only need 50 or 30 in Bangkok in that sense. So we can actually do our acquisition strategy also quite different for these photographers.
Yeah, exactly. So the acquisition process was fairly ad hoc, let's call it that. You go on Facebook, you go on Instagram, you find the right photographers in the right location. Location was key. Then you select them based on their gear, because the gear was super important to be able to process the pictures automatically afterwards. Then you select them. You have them doing a test shoot. You ask them to shoot their own apartment, see what it gives, see if they're able to respect guidelines, if they don't go crazy on lighting or on whatever. And then you try to feed them enough gigs so they actually remain on your base, and not start going all over the place.
Very good. So you spent some time at Miro. You helped them raise this big financing round, $230 million US. But then 1.5 years ago, you actually switched over to our portfolio company, and you're now the CFO of Byrd, and we're really happy to have you on board. I can imagine that maybe some people in the audience don't really know what Byrd is actually doing, because it's not the scooter thing, it's actually not a Byrd. So maybe you want to give a quick intro on what the company is doing.
Not the scooter, so we're a e-commerce fulfillment company. We basically run a virtual network of warehouses and of carriers. So the warehouses do exist, so it's not virtual in the sense that it's thin air. But we don't own the warehouses. We partner with existing warehouses and fulfillment centers, as we call them. And we basically run the warehouse through our technologies, through our warehouse management software, which we've developed from scratch. And we basically allow any direct-to-consumer e-commerce merchant to fulfill their sales anywhere across Europe.
Right, so if you're like storing, shipping, packing,
exactly.
Goods,
so
the
e-merchants will send us all of their inventory. We will allocate it to one or multiple warehouses, and from there on, we take over the entire logistics and fulfillment tasks, which go from storage, pick, pack, ship, returns handling, and hopefully that's it.
So this is like a highly managed marketplace where Byrd really takes control of I would say the quality level on the supply side, with both the warehouses as well as the fulfillment provider, so Hermes, DHL, etc. You already alluded to it a little bit, but effectively in this market there's two dominant approaches. One is the approach that you're following with Byrd, which is what I would call the Assetlight approach. So you don't run or own any of the warehouses. But then there are also platforms that actually do operate these warehouses themselves, right? So I think in France you have Cuban, which also raised quite some money. But they basically operate their own warehouses, so a slightly different approach. I would love to kind of get your take on the trade-offs between these two models and why Byrd ended up doing the Assetlight one.
Yeah, basically we're pretty convinced that the Assetlight model is the right one, and you're probably too, because you're invested. So I guess you're converted. But yeah, it goes back to the whole marketplace model itself. There is supply across Europe. There's empty warehouses. There is warehouse operators that are begging for more volume so that they can fill their warehouse and actually make the warehouse make economical sense. And so just intuitively, it would be an obvious waste to not use that, to not make use of that supply and of that free space. And once you've established that, you realize all of the benefits that you're going to get from running a virtual network or from running a marketplace model. Basically, we're 10 times more scalable and faster at expanding than if we were building our own warehouses in any geography where we want to expand. We become a lot more disciplined in terms of what sort of fulfillment we're able to do, because if it doesn't work within our software, we basically can't do it. Whereas if you have your own warehouse, you always think, okay, well, I'll take this customer over and the size of the packages are a bit bigger, but we'll make it work. And that creates operational complexity and a bit of a shit show in your warehouse.
Yeah.
Whereas we literally don't have a choice, because we're running everything virtually through the software. And that allows us to keep a lot more control on what's going on in the warehouse, on what sort of customers we take on, and on the entire business, really.
Yeah. I mean, for me personally, I think Byrd had a bit of a journey, right? Because we actually started with our own warehouse, and I still remember the first board meeting, and the guys asked me like, "Yeah, we actually want to use like 50,000 euros to buy a forklift," and I said, "Okay, that's great, but let's make sure this is the last forklift that you buy." Maybe one of the rationales that we had as an investor on backing this space, and I think time will tell whether we're right or wrong, right? I mean, we're still fairly early in the journey. Is that, obviously for an asset-heavy model where you run your own warehouse, you obviously need a lot of cash to finance that up front. Plus, it also kind of changed the outlook of your business. So at least that's our perspective. So while we really like to invest in marketplace businesses because they have great exit potential and also reasonable valuations at exit, I think if you look at like logistics business per se, they're not really valued that great, So it's also kind of like a little bit how you build value over time, and we think that like actually have like an asset-light approach where you run truly as a marketplace, yet being very highly managed. We still think it's the best bet, but we're still early on that front.
Yeah, for the highly managed, in that space, you don't really have a choice because you have a warehouse which you need to operate in a certain manner. So the level of management is extremely high, because if the warehouse does anything that doesn't work through the software, we basically can't work with those warehouses.
Yeah, and we obviously have the benefit of working with existing warehouses, so we give incremental volume to them. Whereas if you start with a warehouse from scratch, you actually need to get a certain volume in order to make it like profitable, right? So I think it has like slightly different economics to it as well.
Yes, it does.
When we discussed it before, you mentioned that the less you want to run the operations in the warehouses, the more time and energy and money you need to spend on actually curating the right one, right? So can you talk a little bit about how you do that at Byrd? So how do you curate your supply side?
Yep.
And to what extent that was different maybe to, I don't know, like Miro or...
Yeah, so I said it already, the main selection criterion is the software itself. If the warehouse operator cannot or doesn't want to accept your software, or is already running on another software or whatever, that's already a big selection criterion. And the next one is quality. It's really going to the warehouse, meeting the people, making sure that they are tech savvy, because you want them to use the technology, you want them to be automated in their mindset, and you want them to work in a scalable manner. So that's what we're looking for, and that's the level of quality, because you in supply chain and in logistics, you can't do 80-20. A parcel that doesn't arrive is a failure, and that creates a ton of tickets for the customer service team. And if you don't have control on what's actually happened, that's just not acceptable. So the level of quality is really what we're looking for, and the tech savviness and the scalability of the warehouses, the mindset of scalability is really what we're looking for.
Nice. I guess price also important somehow, What are you paying for your service?
It's actually pretty standard, and the pricing is the warehouses know about the prices, and the pick, pack, ship, they're pretty basic acts or things to do. And so once you have a scanner, picking, packing, shipping is going to be at the same price.
Right.
There's a market standard, let's say.
Right, okay. So maybe two more questions before we try to wrap it up. So one is, I would say similar to maybe Miro, where you started to build a lot of products to keep the supply side engaged and happy, you're also probably doing the same at Byrd, right? So are like any particular features that you're just building for that supply side, so to say?
Yeah, so the more advanced you become, the more critical you become to a warehouse, because at the beginning you're just shipping, 20 parcels with within this warehouse, so you're not really critical for them. But some of our warehouse partners, we're basically 90% of their volume, and so that's where you start becoming even more sticky by providing them with the better technology, with conveyor belts, with machines that will actually print the labels and stick them on the cardboard boxes themselves. So all of this automation, that's what is driving the warehouses are super excited about that, because any task is a man hour, and a man hour is money for them. Essentially, they're usually mom and pop companies, so they know exactly how much every second of an employee costs them. And so any automation that you can bring them is a huge step for them. So any scanners, that's what we've developed, right? We've made sure that we've integrated all the best standard hardware, so all the scanners that you have on your wrist or on your finger. The app on the phone is extremely simple to use and is a huge game changer and time winner for the warehouses, and that's really what we're investing on, because that's technology. That's the lifesaver for the warehouses. So that's what we're investing on, and that's what they're super excited about, and that's also what makes the supply super sticky. Because once you are providing them with the software, with the hardware, and with the volume, basically they don't really have that much leverage anymore.
Yeah, I mean, we started the event today with actually a panel on financial services. We haven't really introduced a lot of financial services yet at Byrd, and maybe you can also not really comment on, let's say, the near-term product roadmap. But do you see like a future for also like financial services on Byrd solution?
Yeah, we were talking about marketplaces owning the data. Well, two things. Our merchants send their merchandise to us, so we're basically sitting on their inventory. And the first thing they tell us is, we're negotiating prices with you because we've spent so much on producing those water bottles or food supplements that you're shipping for us, and they're sitting in your inventory. So you've got about, for some of them, it's 3 million euros of inventory sitting in our warehouses. And so one obvious thing that they're keen to get from us would be inventory financing. And it goes back to the same question: do we want to build it ourselves, or do we want to partner with a partner? Partner with a partner. But yeah, that's the question we're asking ourselves at the moment. The other one is also an obvious one: is they have all this value in our warehouses, and we're shipping it through DHL or La Poste or whoever. What about insurance? So yes, we do have to offer them insurance, because that's people are nervous about their inventory and about transportation, etc. So yeah, insurance is the other obvious one, and that's where supply chain and logistics is an obvious gateway towards financial services, because that's, I mean, the upsides are countless. It makes it more sticky. It makes more margin. It's all of the above.
I mean, something to look forward to. Maybe before we wrap it up and we do the Q&A at the drinks. I mean, you obviously had this journey of working like at an unmanaged marketplace to a highly managed one. Any like 2 or 3 kind of key learnings or messages you want to share with the audience before we start drinking?
Sure. Yeah, the first one is, a marketplace is always two-sided. There's the supply, there's the demand. Nicolas, who was sitting here at the very beginning, was saying supply is key, and it's for every marketplace you have to strike the right balance. For Airbnb, the hosts are the holy grail, and so they treat the hosts super well. For Uber, it's the demand, it's the people taking the rides, and the drivers get treated not so well by Uber. So where you put your money and how you invest in one or the other side is a super difficult balance to strike, and so finding that balance is really key for any marketplace. And the other one is technology. Just you're liquefying something, an interaction between supply and demand. Make sure you do this through technology and not just through people, because the technology is what's going to make it work and going to make it sticky and actually going to disrupt the market that you're addressing.
Thank you. I guess with that we wrap it up and we head out to the drinks.